Welcome to International Securities Exchange's podcast series. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So let's look at this in real-world trading. And again, it doesn't matter what market this is or time frame. So here we have a hammer. Okay, and notice this is one of the things we do in our trading. We'll look for a hammer. And if the market pulls back to the hammer support area, we'll think about buying. All right. So the market got here. Okay. This is an intraday chart. It could be a daily chart. Doesn't matter. But no bullish signals here. The first bullish signal we really got was over here. And here's where I'm going to ask Steve my first question, because Steve is an option expert. I'm certainly not. So one of the things that we could be thinking of doing is the way I'd be looking at this is maybe the market opens here, and you're not sure it's going to close as a tall white candle, so maybe lightly buying a call over here, and then maybe if the market rallies here, there's a couple of choices. We could either leg in and do a bull call spread, and this way we lessen our risk, or we could just maybe take some profits, or just let the call ride. But my question to you, Steve, is let's just say we buy it. Let's say intraday over here. Let's say we don't know it's a bullish engulfing on this tall, and that is actually, a bullish signal. We'll look at it a little bit later, bullish engulfing pattern. But let's say as the market's rallying, we buy it. So a stop-out level would be under the low of the hammer, and my target would be over here. Now, candles are not going to help you with volatility, and candles don't give timing. But candles are great for giving you, when I say timing, I mean it doesn't say how fast the market's going to go. But far and away, the most important aspect of an option trade is obviously direction. So this is telling me the direction is going to change. So would we do a spread on this, Stephen, or we just do an outright call? And let's say, we buy it, let's say over here as the market's moving up, and, guessing we would reach the target within, let's say, based on this, 4 or 5 or 6 days with a stop over here. So we'd be buying it here, we'd have a stop down here, and this would be the target within about a week or so. So would we just be a long call? Would we do a bull call spread or some bull put spread or something? What's your thinking on this?
I mean, I guess what I would look at is, how big is that base and how confident are you? And if you felt that the market...
I'm pretty confident, yeah.
Yeah, if you're pretty confident, then you might look to a single call, and as you said, quite possibly legging in as the market rallied in your favor. So rather than, if you were very confident or fairly confident, rather than doing the 89, let's say 91 or 92 spread, maybe just buy an 89 call, and as the market rallies, you might sell another option to give yourself a bit of a hedge. I mean, that'd be one way. You could also buy in.
And what option would you do if it's rallying? Which would you sell? Would you sell a 90 and some specific numbers? Which would you do?
I probably would give myself a little more spread with. So if I bought an 89, I wouldn't sell a 90 because again, the most I can make on that trade might be $1.
Right.
So I would probably widen it out a bit, but you have to be realistic. So that's a good point. You can't sell an option that has very little value. So you have to look in the month that you're trading, and hopefully you're selling, let's say, a 92 or 93. And my general rule, now again, this is a general rule, is I don't like to sell options for under a certain value. So I'm just going to give you a number that is just arbitrary, but I might not want to sell an option for under 30 cents because I just don't like the risk reward of giving up my upside for such a low amount of money. So I would look for a month or a strike that was above that, and look at the risk reward of the trade and go from there. When I'm trading options, I'm always thinking about how far and how fast. So if I'm very bullish, I don't know timing per se. None of us really do, although if I'm very aggressive, I might be looking at a front month or a second month option and thinking about selling that higher strike as the market rallies.
Okay, and if I wasn't as confident, would we start with a spread?
Probably put the spread on. Exactly, Steve. Great point. If I wanted to have a less of a debit in my trade, or if I was concerned about volatility, as you pointed out, because I'm concerned of what is that volatility? Is it fair? I get this question all the time. I might say, well, just do the 89-92 spread, and I'm just going to pick a risk reward. I don't know what the right risk reward is, but let's say that I put the spread on for $1, a debit, I can make $2 on that, and then I might think to myself, oh, I like that risk reward. Risking 1 to make 2, that might make sense to me. So then I don't worry about volatility really anymore, because most of the volatility, not all, but most of the volatility will be hedged by selling that other option.
Mm-hmm. Okay, great, thanks. And can you see my arrow? It looks like Gil is saying he can't see what I'm talking about here and there. Can everybody see my arrow right now? I'm pointing on that green candle. Can everybody see that?
No.
No. Okay. Let me get it. I thought I had. Do I have to? Is there a way to turn them?
Yeah. Click on that arrow at the top.
Right. That's what I thought I did. Okay. I'm clicking on the arrow.
Like here, everyone probably sees mine.
Right. Okay. Let me try.
And you should.
There we go.
Yeah.
Okay.
There we go.
There we go. Okay. You know why? I didn't left mouse click. Okay.
Sorry.
Thanks, Gil. Actually, I was doing that to see if anybody was paying attention. So, thanks. Okay. So here's where I was talking about when I asked Stephen about buying it. Over here, and I would be very confident about this trade. And this, we're getting a little ahead, but we'll segue into it a little bit now. But this is why I like adding Western technicals to the candles, because the more technical signals we have joined together, the more confident I would become. And the more confident, again, I'm assuming, Steve, if you disagree with me, let me know. But the more confident, the more likely I'd just be doing a directional trade rather than an outright. And again, I'm not taking into account volatility or anything like that. I'm just talking about confidence over here.
Absolutely.
Great. Okay. If Steve and I agree, then we're wrong. Okay. Then we have to worry. Okay. Now, the opposite of the hammer is the shooting star. One of the great things about the candles is that that there's pretty much an opposite pattern. So if you have a bullish candlestick signal, you should know in the back of your mind that there's an opposite bearish counterpart. So the opposite of that would be a shooting star, very long upper shadow, small real body at the bottom end of the trading range. And again, remember the magic of candles. It reveals the market psychology. So obviously a potential top reversal signal. Of course, there's always a price that says we're wrong. If the market closes above the high of the shooting star, it's a bearish, it's a bullish breakout. You can actually do momentum with candles. Once again, a little beyond the scope of the session here, but for those who like buying on strength, let the market close above the high of the shooting star. That's a break above the resistance area, and you could do, some sort of bullish option trade. But again, just wanted to throw that out there, a little beyond the scope of the session here. Now, I have about 15 what I call Nison trading principles, and one of them, and I made reference to this just a couple of minutes ago, is the more signals we have joined together, the more likely reversal. And this gives me my degree of confidence. And when Stephen asked me if I was more confident on the last chart, the reason I said confident is because it was confirming a Western signal. And this aspect of East and West, this was a cover star, an article that Active Trader did about me a few years ago. And the reason I wanted to show you this is because they came up with the title after the interview, and they pick up very quickly how important it was to add candles, i.e. Eastern signals, to Western signals. So one thing that's of key importance is whatever you're learning, whatever educational seminars you're getting from ISE, obviously continue using the methods, and wherever you get elsewhere, any resources, any books, or any DVDs you get, whatever it is, use all your indicators, even fundamentals, and then add the candles as the final trigger. And the trigger might be not to be doing the trade. You get a doji at a new high, I'd be very circumspect. I'd be very nervous about buying. If you get a tall white candle on a bullish breakout, that's a big positive. And I almost said on high volume because I'm used to doing a lot of webcasts on equities. But one of the great things about candles, and they're certainly not a substitute for volume, but because you could use candles to gauge the force of the move, you could use that something like you would with volume. So if you have a tall white candle, you could say it's a strong move. If you have a doji, you could say it's an indecisive move. So that kind of overcomes one of the limitations of Forex insofar as there's no volume. Use the size of the real bodies as the sense of the move.
Thank you for listening to our podcast. Please visit www.ise.com/podcasts.